How y'all doing? Welcome to Trading Conviction, where it's all about trading, finance, and leveling up your personal economy. Today, I'm going to show you why options are a powerful tool. And just to be clear, this is what I do. I'm not telling y'all to go and do the same. I'm simply here to educate and share some knowledge with y'all. Let's get into it. All right, I got the Mara chart up. Okay, so right here, I'm gonna mark down options so we know it's options I'm doing. So I got options, and what I do first is majority of people are going to buy shares, especially if you're just getting into the markets, right? Some people get into futures and all that, but that's something else, right? But majority of people, they hear about stocks and then they get into stocks and then try to buy some up, hoping that price is going to push up higher. Some advanced people will start selling, doing shorting. That's if you're trading also, but majority of the time it's the buying. But that's not what I do. So I do not purchase stocks outright. What I do is I sell cash secured puts. Okay, so with this, with options, right, I sell cash secured put contracts. And if you guys need to know what some of these terms means, go check out some of these YouTube videos that show you or teach you all about the basics of options contracts and what these some of these terms mean. Now, with options, I sell cash secured puts. All right. And then from these cash secured puts, I collect, right? Typically, I'll sell them about 1 to 2 weeks out, meaning that's the expiration. And we collect premiums. Okay. Now, with those premiums, right, what happens with the cash secured put is that that money gets locked in and the premiums just help reduce the cost basis of the stock. So if the stock is selling at $12 and I sell a contract for 50 cents, that's 50 cents times 100, which would be $50. Then when this stock gets assigned or exercised, instead of it being $12, it'll be $11.50 a share, which is times 100, so it'll cost me 1,150. So premiums about 1 to 2 weeks out, and then this is what I'll keep doing. All right, if they expire worthless, okay, worthless, then I get to keep these premiums, and then I'll keep selling cash secured puts. I'll do this with stocks I even want to buy that I even want to be in, right? Because this is a good way to start collecting premiums and keep them in there. And potentially can sell deep in the money cash secured puts, right? But if price is pulling down, it might not get assigned. So about 1 to 2 weeks, right? Because eventually, if price is pushed down lower, you'll eventually get assigned, and then you're gonna see some of what we can do when we go when they get exercised or assigned. So now, if we're not able to do this, right, and then it gets what assigned, right, or let's say exercised. Okay, so assignment means that the expiration date comes up and it's in the money. It's in the money, right? At or in the money, it gets assigned, meaning that I'm forced to buy the shares. Exercise means at or before the expiration date and time, and right, someone says, "Nah, I don't want it no more," or "I want extra. I want you to fulfill that contract," so then I have to buy those shares. And the share it's 100 shares. Each contract is 100 shares. So once it's assigned and exercised, then I have to buy the stock. Sign, exercise. What is it? Buy stock. So 100 shares. Okay. So now let's say, right, those shares I bought up were at what I told you, the $11.50, which equals times 100, which is 1,150. Okay. Now, what will I do next? Now I have the stocks. Now what I'll do is I'll sell what's called covered calls. Okay. And with covered calls, unlike cash secured puts, which I said, cash secured puts, that money gets locked up, and then that premium that is generated is used to reduce the cost basis of that stock when you have to buy it up. So this stock would have been actually $12, but the premiums reduce the cost. But with covered calls, right, you collect the premiums right away. Like you can use them right away, right when you get them. So I'll sell covered calls, but not just regular covered calls. These will be, and I didn't even add it on here. These will be deep in the money leap covered calls, meaning that the expiration date on here will be about 1 year to 2 years out. Okay, so at $11. Well, it'd be about $12. At $12, 1 or 2 years out, I could probably sell a $3 strike price contract at about through $12. That'll be about $7. So $7. No, not seven. That'll be 9, 10, 11, 12. About, let's say, $900 in premiums. Okay. Now, 900 is less than the amount you use to purchase up, right, the stocks. But with this $900 in premium, again, you get it right now. So what do we do with that $900 in premium? We use it to purchase some more cash secured puts. Okay, so what is likely to happen? So if this cash secured put got exercised and assigned, that means that more than likely, right, price had moved lower. So that means when you go buy some cash secured puts, you'll be able to get into them because the price would be lower, and then you can still generate some premiums over here. Hopefully, you're collecting, right? Which I do typically. I'll get about once to about 3 weeks worth of premiums before it gets assigned. Sometimes a little bit earlier, but I'll get it. It'll typically eventually get assigned, and then it'll go over here, and then you just keep doing it. Okay. This is a great way to reduce your risk, especially if you're in the stock, right? And or a great way to put some of these premiums if you want in reserves, so that way it can offset if you have any losses once you eventually get the stocks. But one thing I did want to show you is that after this one purchase right here that you had to give this money up, right? You had to use your funds, but eventually you can start using the premiums from the market to furnish the buying of more cash securities and stocks. So let's just say things keep going down. Okay, so you get a $3 strike right here. Then let's say you do another one. So these strikes would likely go down. But say you do another one, it goes from $12 to let's say $11. So that'll be about 1050, right? 1050, yeah. So three, so that'll be what, eight. Let's say you do 800, and then I'm not gonna keep going along with that, but say that you keep doing this. So you can keep doing this, right, and continue to buy up, right, or not buy up, or sell deep in the money leap covered calls, right? And these premiums will still be the one you're using. Like these are not adding up, but the ones that are adding up is the strike price. So for Mara, I think Mara is gonna push up higher when crypto pushes up higher. So eventually these deep in the money leap covered calls will get assigned. The price pushes up significantly, they'll get exercised, but at least assigned. So you're gonna have to wait 1 to 2 years, depending on when that expiration is. But if you do this enough, let's say you do this 10 to 20 times. So if you do this 10 to 20 times, that would mean $3, let's say times 10 would equal $3,000. If done 20x, that would equal 6,000. So, right, that means that if this deep in the money leap covered call, right, let's say just stagnant and you didn't really even make nothing, that means at least you would know that you would make more money because you spent 1,150, but you made 3,000 or 6,000, which is what, over 100% profit, right, within 1 or 2 years. So that is really, really, really good. And who knows if you generated some premiums on this side, and if you did, you're even cooking a little bit more, so it just adds to that. Now, some of the caveats is what happens if, right, price pushes lower. So now you're in all of these, price pushes lower, or the company goes to zero. Could potentially happen. So if that's the case, that means, of course, you would not get paid out, but you would keep whatever the premiums was on the last one you sold. So let's say it's 800, you would still have the $800 premium. So how's your risk mitigated? Because that $1,150 you had funds you had used, right? You didn't lose all of it. All you did was lose, right, that 1150 minus 800, which would be what, about $350 that you lost. So instead of going all the way to zero, you lost just 350, and you still can do some stuff with $800. But this is a great way if you can keep generating something like this, and this is what I'm doing. I started off with Bit Farms, and then I went to Riot, and eventually upgraded to Mara, and then I had about one or two, and now I have significant amount more generated off, right, the same amount I've put in when I bought just a couple Maras, or a couple contracts on Mara, right, and I kept generating more and more and more. And eventually, when these things get assigned and exercised, I'll collect the money from the people that will buy the stocks off of me. So that's what I do. I'm not telling y'all to do it, but that's all I got for now. If you like the video, hook it up, double meat, double cheese. Hit that like, share, and subscribe button, and don't forget to turn on notifications. Hey, drop a comment below. Let me know what y'all up to. Wishing y'all some great trading out there. So stick to your decisions, follow your plans, and remember, it's only fiction without conviction.